Welcome to the monthly call with regards to the market outlook. Today we have with us our fund manager, Mr. Nikhil Gada, uh, who would brief us with regards to how the markets look like and with regards to our portfolio strategies. Before we start, a brief introduction with regards to Nikhil. Nikhil has an experience of around 10 years in the markets. He is a B and is a CFA charter holder. Not taking much of your time, over to you, Nikhil ji.
Thanks, Anup, and welcome all for this webinar. What I will do first is that I will take you through, our overall market outlook, our overall strategy in terms of stock selection and, portfolio creation. And then finally, with the current portfolio updates, what the changes we have made. And then we can, sort of end it with a Q&A session as well. I'll quickly start first with the outlook. Firstly, if you see how the current market situation has panned out, if you see the recent uh, performances in the last 6 months to 1 year, uh, frankly, it's not been, very great for the Indian markets per se. If you see many other markets globally have done much better. But if you see from a longer term horizon, be it from a 3 year to 5 year horizon, the Indian markets have definitely done way better than most of the markets. And it has largely been because of a lot of factors post-COVID that worked really well in our favor, be it also from the low base that we had achieved. Uh, but in the recent time, what we have seen over here, if you see in the last 6 months time frame or 1 year time frame, has been a lot of factors that have gone into it. Firstly, India overall was seeing a sharp slowdown in terms of not only the overall consumption in the market, but also a big bellwether which was driving the markets for a long time, which was the government fueled capex and the order flows. And since last year, we saw a string of elections, starting with the general election and then, four key state elections. And hence, because of the overall model code of conduct, etc., the order booking also started slowing down in the system. And hence, it sort of, culminated in a year, which is fiscal year 25, of, very, very muted earnings growth. We closed, Nifty earnings were close to 4 to 5% in FY25 after 4 years of 15 to 20% sort of an earnings growth. So that was definitely something which had impacted. Apart from that, yeah, there were a few other things as well. uh, Something on the geopolitics front as well. We saw the Russia Ukraine crisis was already going on, but we also saw uh, crisis in the Middle East, starting with the Israel uh, and the Hamas war, and then it sort of escalating further. And by the time we started entering FY 26 fiscal year, we started seeing the overall Trump tariff tantrums, which sort of still continues. So from that perspective, we have to view the current numbers for India as a market overall. Just getting into, the key question, and I think a lot of you would have this question in your minds that what actually Trump's end game would be with the overall tariff situation. Uh, I think one of the things that definitely he's trying to do is that trying to get more of the production or the manufacturing back into the United States, which is something which has largely been transferred to the likes of China and to some extent other emerging economies like in India, Vietnam, Mexico, etc. And in doing so, there has been a lot of arm twisting from them. And the overall barbs from him in terms of I'll put in so much of a tariff, 30%, 40%, to an extent even going to 130, 140% in case of China. That was something which he was broadly trying to bring most of these countries on the negotiation table. Uh, In that context, just while we're discussing this, one thing which we really worked out positively for us is that India from day one post the announcement of tariffs that Trump was going to put in has directly engaged with United States in trying to find an amiable solution where they can work in a better way to uh, assuage a lot of his issues, and also in a way where it's beneficial for not only the United States but also for India. And I think India was one of the few countries who did that from day one. And I think from that perspective, we will stand to be at a more better footing vis-a-vis others. But in terms of where this entire tariff situation can take us, there is no specific answer for that. We will have to wait and watch. I think one thing is for sure that post this entire situation is done with, there would be a few winners who could emerge, but we will only be able to judge that once this entire situation is behind us. So for the time being, the volatility because of whatever Donald Trump is trying to achieve will continue to remain in the system in our view. Uh, and in context, what we are currently seeing in terms of the tariffs, if you see China is at 30%, Vietnam they've already given 20%. Currently India is the only country where the talks are still to be somewhere around 10%. At least that's what we hear from the overall reports. And if that is the situation, then this is something which could be a big boost for India, uh, because you will always, to a lot extent, we always say that we are at a, uh, sort of impacted vis-a-vis China because of their overall cost of production is much lower, and a lot of uh, the state benefits from China that comes to those companies. I think this sort of can neutralize and even benefit us, in a longer term perspective, if we get this 10% sort of a tariff, which we could be aiming for. And in terms of the overall trade, I will also discuss this at length in further as well. But just to complete this point, yes, overall India trades. Although our overall exports per se is only 3-4% of our GDP, but US remains one of our largest trading partners, and hence any impact over there could have an impact. But if the benefit turns out, then this can become a very big opportunity for India in the overall scheme of things. And so, from that perspective, I think India stands to be on a better footing vis-a-vis most of the other countries. Just in terms of, whatever Donald Trump was trying to achieve with these tariffs, one thing which he felt was that if the tariffs at whatever rates they remain, he will be able to, absorb the pressure, because if you see what he was expecting was that, the way the current situation was, he expected a dollar to appreciate at least 4-5%, which it did initially. And, apart from that, he would want the companies to take the blow of another 2-3%, and then the remaining benefit he would pass on in terms of tax rate cuts, and hence the end consumer in US would not really be challenged or be impacted by this tariff that is trying to achieve. Now in that situation, when he initially started this entire thing, it sort of led to some amount of appreciation in the dollar, where we saw the DXY index going to 107, 108 levels. But slowly and steadily, if you've seen, once again, the dollar has depreciated. And one of the key factors have been that, uh, a lot of the countries are really not liking the way Trump is dictating his overall situation, and just the dollar dominance as a reserve currency. So all those things could be a challenge, and if you see, that is something which has led to uh, the overall depreciation as well in the recent 1 or 2 months as well. In terms of India's, while if you see the chart below at the bottom left, we see that most of the currencies have actually seen good appreciation in the last 1 year. India has seen a minute depreciation, and the major reason being that while this entire appreciation was happening in the dollar, the Indian rupee actually was quite sturdy and did not see much depreciation, and hence you can see that it turned out to be relatively less volatile compared to a few of the other currencies as well. And to top it all, you have a forex reserve which is upwards of $700 billion. So that is also helping India. Plus a lot of other factors that India domestically are also being doing, which is in terms of their overall fiscal prudence, and also your inflation also rates being quietly in check as well. So from all those perspectives, we have to see the current currency movement, and it can be in future that we might see the dollar can see some more depreciation, but from that perspective, we are still sort of shielded that way because our overall uh, outlook and our overall economy remains quite resilient. And in fact, if there's some amount of rupee appreciation, that only will be beneficial for us. For US, this could turn out to be something which could drive their inflation bit more higher, and hence you see, Mr. Trump coming quickly on the negotiating table and trying to create a more better framework for negotiations, and to ensure that this does not spiral into US going into recession because of this high inflation and the overall demand in US starting to slow down, which is already doing, but can that can overall exacerbate the situation. So from that perspective, I think this entire situation is that we see currently. Coming back to the Indian markets and the overall flows front, and while I discussed the FII selling or the amount of selling that the FII did in the past 2 years, one good thing if you see is that in this entire 2.5 years, the domestic flows have remained very, very resilient. In fact, if you see for the current year of first half of CY25, we have seen inflow. And to just give it in context of the overall mutual fund industry, that's close to 7% of the total mutual fund industry holding currently. So the overall inflows continues to remain very, very strong. And while the FII sellings have been very, very brutal in the last couple of years, and the major reason not only being that the valuations looked very high in India, but also because of the dollar appreciation that they were envisaging, and hence the overall dollar returns would not be so good for them, and that has also led to a lot of FII selling. But if you see from while the first, if I see the 6 month, the first 3 months, we saw decent selling from the FII, but in the last 3 months, they have sort of gone back to the markets on the emerging markets front, where they see a decent, strong leadership, decent earnings, good corporate governance, etc., and good earnings visibility as well. And also to a certain extent, if their view might be also that the dollar is starting to depreciate, so it would give them better returns as well. So that has also sort of forced their hand into getting back into India. While the overall inflows in the last 2 3 months, it's not been something very great. I think around $2 billion odd, but it's something which also has sort of supported the Indian market in the last 2 months or so after the sharp correction that we had seen in the months of Jan to March. Now, coming to the overall market outlook and the overall macro situation in India. Now, if you see, firstly, uh, after a very disappointing Q2 GDP print of around 5.6%, Q3 and Q4 have turned out to be good. And in fact, Q4 was one of our better quarters, close to 7.4% GDP growth we saw. And that took us to around 6 to 6.3% levels in GDP for FY25. And a lot of reasons, as I already mentioned about the overall slowdown in the system. But then once the new government took oath and also the state elections were done, we started seeing renewed order flows, etc., and more execution on the ground, sort of boosting the GDP for the fourth quarter. For FY26, we expect the GDP growth to be in a similar range of 6.4% and nominal GDP to be around 10.5%. And when we look at it, we should look at it from the overall context of what we are going through as a world in terms of the overall volatility, the Trump tariffs, the geopolitical situation. And from that perspective, India still looks on a decent footing from that perspective. And one of the other things that the government has done really well has been their fiscal prudence in not going overboard in terms of their overall spending just to attain growth. If you see post-COVID, there has been a very uh, glide way in which the overall fiscal deficit to GDP has come down, and we are targeting from 4.9%, which we saw in 4.8, 4.9 we saw in FY25. We are targeting to bring this down to 4.4% while maintaining our focus on growth, our focus on capex spendings, and also the tax rate cuts that they have already provided. So they've managed everything quite well while still creating a good fiscal environment, and hence a lot of the factors keeps us very positive on the Indian market. The chart over here where we are showing the overall capital expenditure, now this has to be viewed in terms of what has transpired in the last 7 to 10 years. Well, a lot of the heavy lifting for the overall Indian economy has been done the capital expenditure. We have seen a lot of infra development. We continue to see that. We have also seen a sharp increase in Atmanirbharta, where we are focusing now more on making a lot of the things which we can in India, be it in electronics, be it in defense. Also, you can see a lot of uh, fertilizer subsidy being given on time to create to foster the farmers to create more and more crops, etc. And so all these things we have been very inward looking for the last 7 to 10 years, and that has also helped us, shield us from whatever we are seeing globally, where Trump is trying to dictate a lot of terms, because India still largely remains a domestic driven economy, and hence we still remain on a very strong footing. The overall government capex as a percent of GDP has also been quite strong. It is now sort of plateauing out at 3.1, 3.2%, which we feel is something where it might stay until and unless we start seeing more and more improvement in our overall finances, and that could all be largely attributed to the how crude prices behave. So that can always give us more room in terms of further capex spends if we want to. But in the current scheme of things, we still see the capex expenditure to be in the range of 9 to 10% for the coming year, and which is more or less in line with how we also see our overall GDP growth to shape up. Apart from this, there was a clear indication of a consumption slowdown that we were seeing for the past 2.5 years, and that is something which the government also sort of spotted out. And hence, if you see, and in the coming 2, 3 slides, I will show how a lot of measures that they have taken. So, firstly, if you see, there has been in the recent RBI policy meet, they have done a 50 bips rate cut. Uh, and to concur it with the other 225 bips rate cut, there's been close to 100 bips rate cut, repo rate cuts, and this has largely been to create an environment where your overall cost of capital goes down, and you start seeing more and more increase in credit growth, which was also seeing a slowdown. In fact, the current credit growth numbers have now gone below even the 10% growth levels, which have was unheard of in the past 3 4 years. So these things will definitely foster a lot of investment in future, and will make a lot of the uh, larger companies, put in more capex, etc. Also, the risk weight cuts for bank loans, so that has also freed up a lot of space for the NBFCs and the microfinance sectors to go out and lend more, which was curtailed to a large extent in the last 12 to 18 months. So that is a clear shift from RBI in terms of infusing liquidity. They have already done a lot of OMOs. If you see the open market operations, as well as the CRR cut, so we were seeing a banking liquidity which was around negative 2 to 2.5 trillion rupees, and that has now increased to close to 2.5 to 3 trillion rupees plus. So there's been a switch of close to 4 5 trillion, and that has largely been to infuse more liquidity, because we are already seeing the inflation levels being down, and the overall consumption has also cooled down because of it. And now is the time to start off sort of restart this entire investment and the growth phase. And they have done most of the things they have in their power. The CRR cut that they have sort of initiated, which is a 100 bips rate cut, will happen in four tranches between September to December. So that will also infuse further liquidity in the system, and hence we will see the credit growth also picking up, and wherever there has been a credit crunch from a lot of the not only the larger corporates but also the SMEs and MSMEs, there we will start seeing more and more improvement as well. Just to sort of uh, infuse the overall inflation picture and with the rate cuts, yes, we have seen the Indian inflation, which used to be very sticky, post 2022 to 23 and to 24 as well, because of the oil prices going up sharply. That has now slowly and steadily started coming down. And if we see, we are close to around 3% levels on the CPI, which has been really, really good, and that has also helped RBI to take this pro-growth measures. And what has also helped has been the crude price behavior. While it has been volatile here and there, we are seeing a crude which is going down slowly and steadily. And while the crude remains at the levels that they are at currently, India will remain very, very positive in terms of their overall balance sheet size as well as their overall inflation outlook as well, because we generally tend to be very susceptible to how crude prices behave. So from that perspective also, we see a very, very positive outlook in the near term. So this was more or less about what the macros were. Now, apart from whatever RBI has done, which definitely will kickstart growth, a lot of the growth triggers which we feel can come in. If you see, this is the GST collection chart, and here we have already seen, the record GST collections coming in. March was one of the best months in terms of the collection, and slowly and steadily we are seeing a 10 to 12% growth in the overall GST collections, which signals two things. One, the economy is starting to once again see signs of positive improvement, and also the overall GST framework has now been largely penetrated into the system, and hence we are seeing this kind of numbers. Secondly, the UPI transaction, this is something like a transaction which we see in terms of how the activity has picked up, and more we see the uh, lot of people going from a cash to a cashless sort of transaction. Um, what has also happened in the near term, if you see, in the first 2 months of FY26, there has been a 54% jump in the order flows that have come into the to most of the companies, and that has purely been a number which we have not seen in the past 5 to 6 years, which clearly indicates that a lot of the government capex might be front loaded, largely to kickstart the growth, which has seen some amount of slowdown. Uh, Also, this is close to around 19-20% of their overall budgeted estimates for capex. So this was largely done because we had seen a lull in the last 6 to 12 months, and that has sort of renewed sentiments as well on the ground. Secondly, we are seeing a very decent monsoon as well. If we see the overall rainfall data, we are seeing close to 8 to 10% of higher rainfall, and which is also now visible in the sowing data as well. This is still July recent data, and if you see the overall sowing data, it's been really, really good, especially in pulses and coarse cereals. Uh, and that also gives us the confidence that the farm income, the rural income, will continue to remain strong. In fact, we saw the rural spending in 4Q to be around 6.6%, 6.7%, and this is 11 quarter high. So while we have seen the urban slowdown still remaining, but the rural economy is starting to see very positive green shoots. And with the ongoing Kharif season also uh, panning out to be, very strong, we feel that the consumption, at least from the rural economy, will only go up from here. Secondly, apart from the RBI cuts, etc., and the capex spends, government to address the consumption part have done a lot of I've taken a lot of measures. One being the large sort of tax slab changes to drive more money in the hands of common man, and to and in that hope that a lot of this will come in the economy in terms of more discretionary spends. If you see the table on the right hand side corner, you see the you can see how the entire tax slab changes have been. And if you move from a old to a new tax regime for a individual who's earning upwards of 20-25 lakhs, the savings comes out to be around 5-6%, which is a healthy savings, and that can also give him more power to execute a certain purchase orders, which he would be sort of deferring purely because he was not seeing any major improvement in his maybe in his gross salary, and to an extent even the tax benefits which he would have expected. So that is something which the government has addressed. Another chart which I would like to highlight, and this is something which a lot of economists sort of talk about as well, is the household savings, which is as a percentage of the GNDI, which is the gross national disposable income. If you see in 23-24, this number was only 5%, but in 25 we have seen this jump up to 6.5%, which shows that there is now enough savings as well with the households, and this clubbed with the tax rate cuts should only foster more consumption in the system in our view. And this a lot of this tax rate cuts will also be beneficial to the urban people, and hence this can also kickstart the urban consumption, which was something which was faltering for. Another trigger, this is more medium term in our view. This is the eighth pay commission hike, which the government has announced recently. Now, the total value from this is around rupees 3.7 trillion incremental, and this is something which will get done in August 27. However, it will be effective from Jan 26. So, but at this point of time, once this sort of is executed, there will be more salary in the hands of most of the government personnel as well. And to just lay it out to you, if you see between FY15 to FY16, the PFC, which is the private final consumption expenditure, now you can see a healthy 1.5% increase. And just to see, PFC is one of the largest contributors to your GDP. And just because of this pay commission, the seventh pay commission hike, we had seen this 1.5% increase. And this is something which we feel will also happen once the eighth pay commission hike is passed on, and this can once again trigger a lot of consumption in India. Lastly, just to close the argument on the growth triggers, uh, we feel that there is a very meaningful export opportunity which can develop for India, maybe in the next 2 to 3 years time frame. The charts which you see on the top is first is the Indian exports chart to the world. And if you see in the last 2 years, there has been no major improvement over here. In fact, we have seen some decline. Uh, and uh, uh, and that is largely been because, as I already mentioned, that we are not so much of an export driven economy. And just to also look at the other chart where we sort of export to US, our exports have largely been stable, and there's been some growth of around 8 to 10%, but not a meaningful growth. Now this should be viewed in context with China, which is a chart at the bottom left. This is India versus China exports to US, and you can see the gap, which was around 5x in 23, and it is almost close to 6.5x in 24. And yeah, the gap is so huge, even if we take 10%, 20% of this, that can be a very, very strong boost, because that will our overall exports to US can increase by close to 50-60% just from that perspective, and that can also drive a lot of growth for us, and that can also address a long-standing issue which we always have had, and that is the private capex uh, not coming into the fore, and that the gross fixed capital formation, which as a percentage of GDP, if you see for India, it's 29% vis-a-vis China, which is 41%. In fact, this number was 31-32% a couple of years back. So we can clearly see that there has been not so much of a capital expenditure participation from the private guys, and it's only been driven by the government. So we feel if the exports can be one opportunity which can make a lot of the corporates start looking at exports in a meaningful way, and that could also kickstart the capex cycle from the private guys. Work is already going on those fronts. So if you see the FTAs which are going to get finalized in the next 1 year's time frame, be it with India, UK, India, Europe, or India, US, which is something which I think will get executed the first. And from that perspective, we can see India, emerging. It will not be a very, very uh, sharp jump straight away, but from a medium term perspective, we feel that this is a very strong opportunity. Quickly coming to then the markets and how the valuations are. I think after the correction that we saw in Jan to March, a lot of the valuation, or if you can say, a lot of the high valuations that were there in the Indian market, that got normalized to certain extent. We have seen a decent run up from second half of April till now, but still the valuations are still at close to a 5% to 5 to 7% premium to the 10-year average. So from that perspective, we are fairly valued, not very expensively valued, etc., which we were maybe 6 to 12 months back. So from that perspective, we feel that we are reasonably placed. Uh, in terms of sectoral valuation as well, once again, if you see the capital goods space, or to an extent, if you see the pharma space and the IT space, a lot of the high valuation phase is largely behind, because we have seen a meaningful correction in most of these places. And also the earnings have also been, while it has not been great, but if you see the capital goods space, there has been a decent earnings. To an extent, the pharma has also seen very decent earnings. The only space which still looks decently valued, or something where you will continue to find value, is the private banks, to an extent even the PSU banks. Um, Auto as well, after a sharp run up, has seen some correction, but in the near term, the overall numbers don't look that encouraging. So we might see the pressure not only on the overall earnings, but on the PE as well, to remain in auto index. Uh, if you see the overall construction material space, yes, here the valuation still remains very, very high, and a lot of it is also to do with what has happened uh, in terms of, if you see the cement business as well, a lot of consolidation happening in that space, and hence a lot of the flows have still been attracted to these guys. Valuation still remain high. Also the earnings, in fact FY25 was one of the worst years for the cement space overall, and the a lot of positive optimism is baked into it, and hence we see the valuations a bit higher. Metal and mining as well, there has been a correction post whatever Trump was trying to do, etc., with a lot of tariffs, on steel and all those places as well. So that has also seen some meaningful correction. And if you see, this is the overall performance of most of the indexes. And our view in this, if you see, we have been positive on the financial for last 1.5 years, and that is slowly panning out in terms of performance as well. And even in the pharma space, we continue to remain positive. Definitely, whatever Trump is trying to do with the tariffs on pharmaceuticals, we believe that is something which should not happen, clearly, because if it's being accommodative to the likes of Apple, etc., in terms of giving more and more shops, I think the basic necessity like medicines will not attract such a high tariff. And uh, it continues to remain something in the works, but we feel that pharma is also a space we feel we continue to remain positive. Metals as well, we feel we might be largely market weight, but with the correction that we have seen in the dollar and the DXY, and if there's some more fiscal stimulus from China, then the metal is a space which can continue to do well. And that is more or less how our uh, sector outlook remains. Just coming then uh, to the risk part, if you see, there are three, four major risks. We feel that a large part of the slowdown in the domestic risk are behind us. Largely, we feel the risk remains global. The tariff wars are already on. The geopolitical tensions, while looks to be abated for now, which can once again flare up anytime soon. A global slowdown is something which can happen based on how the overall tariff situation pans out. So more or less, we feel that if globally there is some shock, definitely India will also be affected, but we might be somewhere down the line cushioned vis-a-vis the overall world. So we might fall less compared to what a global fall might be, but nevertheless, it will still remain a risk for us. quickly just going through, so this was more or less about the market outlook and how we see markets. Quickly just going through our overall philosophy. This is something which we follow. Always focus on, you know, we might say that we are value focused or value conscious, but we always want to find stocks at the right valuation, factoring in the risk reward equation, and hence that is how our overall investment framework works. We generally are patient investors. Our holding period on average is more than 2 years. Flexible, agile, we will always look at all the kind of opportunities that are there in the market. We are not agnostic. We are sector agnostic that way. Uh, Alpha generator is something which we definitely feel that is our overall premise, and that is what we work for to deliver good returns while hoping that the overall risks are within manageable levels. And hence, it's a lot of bottom-up picking that we do, completely fundamental driven approach. And sometimes we are generally the first ones to enter any company, so that way we might be also contrarian investors as well. We follow the meets framework for most of our decision making, where the M stands for management, E for earnings, E for events, T for timing, and S for structural. Uh, it's more or less self-explanatory, but from the perspective of management, we would definitely look at their capital allocation and their track record before investing in any company. Earnings is something which we sort of view every quarter-on-quarter basis and based on overall checks. Uh, we look at structural opportunities in a big way. That has generally been something which we always try to identify in the market. Events, trends, it's something which is there in our framework, but we try to not completely focus on that to take our decisions. And timing is something I think no one can really be good at timing most of the times, but uh, we try to also find opportunities where while the growth outlook might not be that strong right now, but it can work out in the next few quarters, the next couple of years, and the valuation looks in our favor, then that is also something which we tend to look at in our investment framework. Then there is a 5D process where there's a big way of identifying our universe, where we start with a host of companies. Maybe the Indian universe, stock universe is very big, close to 6,000, 7,000 companies. So from there, when we do discover, delve, develop, detail, and deliver. So in this 5D process, every stage keep on screening out companies, and at the end of the day, the final portfolio is a portfolio of 30 to 40 companies, which is largely well researched, well tracked by us, and also something which where the overall earnings outlook looks very, very strong, and while the valuations are something which are in our favor. There are certain things which we don't do, which are the four C's. So we don't chase momentum. We are not into momentum investing. We don't churn unnecessarily. Our churn ratios are very, very less. We don't copy or mimic anyone, and we don't look at loss-making companies or companies where the balance sheets are fractured. Our exit discipline is also something where if the company has not delivered on what they were trying to achieve, but that too we wait. We are patient investors that way, so we wait. But if it's not coming to fruition in the 1 year or 2 year time frame, then we tend to exit. That is our exit philosophy as well. Just quickly on the portfolio update. So we run three schemes in the PMS, which is one is the Abacus all cap approach. Now here the large part of the weightage is towards large cap, anywhere between 40 to 60% of our uh, weightage is towards large caps stocks. Uh, 20%, 30% is towards mid cap, and 10% towards small cap. Uh, in this portfolio, a lot of the, if you see the top 10 holdings as well, you will find names which are more or less resonating with a lot of other, a lot of the top 50, 100 companies that are there in the universe. And while it might be look like an allocation play, but a lot of work has gone into this as well. Like if I can say Aditya Birla Capital, which has done really, really well for us in the last 1 year or so. It might be a mid cap company, but will still have a mention in our top 10 holdings because we allocate it that way where we feel the earnings momentum and the overall valuations are in our favor. The performance over here was sort of muted for last 1 year or so. But if you see the 3 year, 5 year performance continues to remain very strong. In fact, even in the 1 year performance, if you see the 1 month, 3 month returns, we have started to see positive improvement over here. A lot of it is purely because our call on the financials has started to work out, and also a few ideas which we have also sort of invested in. We are still at 8 to 10% cash in the scheme, and that is not because we felt that the market was volatile or something. It is just that we are deploying slowly and steadily and looking at good ideas and then only getting into investment in that. But here we feel that the improvement is visible, and I think this will continue to do well in the coming time. This is the P, the return ratios and the overall PAT growth. While if you see the Nifty P is at somewhere around 1920 with an earnings growth of 11%, you see our index P is around 18 on FY27 with a overall outlook of 20% growth, which is something which we feel is achievable. Second scheme which we have is the emerging opportunity scheme. Now this is a pro return but a bit higher risk scheme where we largely invest in the mid cap and the small cap space, which would occupy close to 70% to 80% of the weightage, and 20% would still be somewhat in the large cap names. But A lot of the names that you will see, the top 10 holdings, is something which is very, very deeply researched, and something which would be the difference that we create in our investment style vis-a-vis maybe some of the other products in the market. And that is purely where we drive our edge. And if you see the overall returns as well in this portfolio has remained very, very strong from a 1 year, 2 year, 3 year, or even inception basis. And that has purely been because of the identification and the amount of time that we have stayed with all these companies which has delivered. Uh, in terms of the outlook still remains very strong. If you see the PE, in spite such a sharp run up in most of these companies, the price to earnings ratio continues to remain very, very affordable at around 18 times, and the overall PAT growth still remains very strong. So uh, while we have seen, the mid cap, small cap not doing well for the past 12 to 18 months, uh, post all the measures which I have already mentioned about, we think that it will kickstart. We are not any major proponents that whether large cap will do well or mid cap or small cap will do well. We feel that overall Indian market should do well, and it just depends on the individual whether they want to have a more concentration towards a mid cap small cap sort of a scheme, or towards a more balanced or a large cap driven scheme. So it is not like if I feel that the large cap is going to do well, then in the emerging portfolio you will suddenly see our allocation increasing to 40% in large cap. That is something which we will not do. Hence, we have a identified scheme for a specific purpose. Uh, and lastly, the last scheme is the Abacus Diversified Alpha Approach, ADAF. Here, it's a scheme where we have 40% large cap, 30% mid cap, 20% small cap, and 10% micro cap. This is a scheme which is between an all cap and emerging, more balanced scheme, I would say. And over here as well, this scheme we started very recently. It's just been 1.5 years. Hence, uh, the overall history is also limited. But over here as well, our cash allocation remains high, 11%. So even here, we are continuing to identify ideas and deploy. And this is something which the work is going on. The ratios, the PE ratio or the growth ratio, once again, very, very attractive that way. We managed it well in that context.
Okay, we'll open the session for the Q&A. Uh, till we gather certain questions, we do have something. Nikhil ji, a question with regards to the bond yields. That is, if the US bond yields rise further, what impact do you anticipate on the Indian equity markets?
See, that is something, which has been an ongoing issue. That if you see what happened post the first round of the Trump tariffs was that the bond yield started spiking up, and hence there was a massive sell-off in the US bond markets, and that sort of also uh, forced Trump's hand into saying that okay, we will postpone the tariffs for a month of 2 to 3 months, and then we will take it up. If the yield spikes up further or there's a sharp increase, we will face some impact, definitely. This will also slow down the US uh, Fed in terms of taking any potential rate cuts, which they were already talking about, or they are talking about in September or December cycle. And yeah, it will not be a very pleasant situation, and we will see the volatility continuing not only in the US market but also in the Indian markets. Yes.
Okay. Okay. The next question is in Abacus emerging opportunities, what is the allocation of small and mid cap?
So if you see small cap is close to 56%, mid cap is close to 34%, so close to 90% is in mid cap and small cap, 7% is large cap, and 3% is cash.
So, which sectors may see impact because of the tariffs, Nikhil ji?
So I sort of widely have mentioned it, but if you see what Trump is trying to achieve, if we see the major focus is towards shifting a lot of manufacturing in US, so definitely manufacturing as a space will see a lot of impact. Pharma is something he's trying to work hard to bring in some production over there. Defense is also something where he wants most of the countries to buy more US defense products. Largely it is towards that, because we all know that US is a technology hub, and most of the countries largely buy US technology for most of the things. So the only uh, place where they are lacking of that is what Trump feels is the manufacturing space, even for that matter autos as well. So a lot of these actions are focused towards that, where he wants a lot of the companies who are doing well globally to come and set up shop in US. Yeah,
Mhm. Okay, Nikhil, can you please show the slide of all cap fund? Uh,
sure.
this one, yeah.
So, is there a question over there?
It's just someone who wants to see the all cap approach once.
So I sort of mention it again. So see, this is a all cap approach is where we do our almost close to 50% of our allocation is towards large cap, close to 30% is towards mid cap, and 13%, as you can currently see, is towards small cap. This is a portfolio. We would not say it's a flexi cap portfolio. It's a stated policy that we'll have 40 to 60% in large cap, and the remaining in mid cap and small cap. And the 40 to 60 can vary based on our conviction of where the market is headed, be it in the large caps or in the mid cap or the small cap.
Okay, Nikhil, one question is what is the outlook for all cap for FY 25-26?
So if you see the outlook wise, I showed you this slide. If you see the FY26 numbers, the PAT growth is expected to be close to 20%. The debt to equity is manageable. The return ratios are trending upwards. And it's not like while we say that, financially something going to do well, even if you see the PAT growth ex financials, even there we are expecting a 17% growth. So from that perspective, we feel that, and this will be still better than the 11% that the Nifty is, which most of the analysts expect for Nifty. This is still going to be better than that. So we have built an all-weather portfolio in our view, and I think things will. And if you see even FY25, the base has been very very favorable. There's been only 3% growth in our universe. So from that perspective, we feel we are poised to deliver good PAT growth these companies that we have, and hence we feel that that will also translate into better returns.
Okay. Uh, Nikhil, next question is what strategy do you use to restructure or rebalance your portfolio during such volatile times?
Yeah, so there is no stated strategy per se. If you see between, and the recent times are a very good example for that. If you see between Feb to maybe April, or Jan to March, where we saw this very very sharp volatility. It's not like we suddenly, most of there were many market veterans who were saying that we took a cash call and October, November, December, etc., we generally have remained cognizant that the valuations were not that great. Hence, our overall deployment of funds was also very slow. I mean, even in all cap, there was a point where we were sitting on decent level of cash, but that was not because we felt that, uh, because the market is volatile or there's going to be very sharp correction. It was purely because we did not find enough opportunities in the market. Recently, we have started finding new and new opportunities, and that is why the framework will always remain in identifying opportunities which are not good from a 3 month or a 6 month perspective, but from a 2 3 year perspective. And that is the framework we follow, and that is how we will deploy our funds. So there is no outright rebalancing that way. Yeah.
Okay. Uh, okay, next question is, even though the diversified alpha is quite a new scheme, can you give us a bit more clarity on how the investments are performing under this particular scheme?
So see, outright we don't, stock specific, we don't sort of give any, specific information. Only thing which I can say is that, while even if you see the cash levels, we are at close to 11% cash levels. A lot of it is towards mid cap and small cap, which you can see currently. Safe to say we might add a few large cap names. But in terms of performance, yes, when we look at the 26 numbers, the PAT growth in 26 compared to all cap is lower. If you see all cap, we are seeing a 20% PAT growth. In this scheme, we are seeing a 13% PAT growth in 26. But if you see the 27 numbers, so that is where we feel, because a lot of these companies in the mid cap and small cap are consumption driven, or benefit from the multiplier effect of consumption, and which we feel will only and hence we feel that this fund, while it is still at a decent footing, will really do well, in the coming year or so.
We have an interesting question coming out. If you are on a 3% cash and emerging portfolio, will you suggest to put extra capital?
As in, I didn't. Okay. So,
So
see,
yeah.
it's not about putting in extra capital. This is a scheme that we run. So if you give us a new capital as well, it will be deployed in this same fashion, where we will have 3% cash. Uh, Most of our investments go, whatever money we get goes into the way the overall model portfolio is structured, and that is how the deployment happens. I hope that is what the
Yeah,
question was.
yeah, definitely.
So thank you so much everyone for joining this webinar. I hope this was worth your time, and we could add any value from that way. We feel that we are in for some exciting times, and equity is an investment vehicle which tends to do really well from a long-term perspective, and hence we feel and the best way to play the India growth story in our view. So that is what I would leave you with. So thank you so much for joining. Thank you.
Okay. Uh, Thank you everybody for participating in this call. Looking forward to you again on the next month's call. Thank you. Thank you so much.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abakkus, nor is it an offer to sell or a generally solicit an offer to become an investor in the services offered by the Abakkus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.